Okay, let's dive into this. Welcome to today's explainer, where we're going to take something that usually makes people want to just pull their hair out. I'm talking about a raw block of tax computation. We are going to completely decode it. We're taking a dense, kind of intimidating financial table and turning it into a crystal clear story. Because, and hear me out on this, tax codes aren't just dry numbers. They're actually this set of highly logical rules, complete with their own built-in plot twists. So today's mission? We're breaking down exactly how income is calculated in a very specific, yet super common scenario. We'll look at the nuts and bolts of tax brackets, those sudden penalties when you earn just a little bit too much, and the relief mechanisms perfectly designed to soften that blow. So get ready, because by the end of this explainer, you're going to be reading tax tables like an absolute pro.
To do this, we need a protagonist. So meet Mr. Arvind. Now, Mr. Arvind has had a pretty decent year, and we need to establish the stakes right up front. His total income is exactly 12,30,000 rupees. Let that number sink in for a second. 12,30,000 rupees. Now, obviously, it's a great milestone, but in the world of taxation, it's also a deeply fascinating number simply because of where it sits. See, it sits just above a major psychological and financial threshold. That extra 30,000 rupees sitting right over the 12 lakh mark, that is going to trigger a wild chain reaction in how his taxes are computed. This isn't just a story about how much he made. It's about the precise journey every single one of those rupees takes through the tax system. But, before we run the numbers, we have to know exactly which rulebook we're playing by. For Mr. Arvind's case study, we are operating strictly under the financial year 2025-26 default tax regime. And honestly, establishing this context is everything. The rules change, slabs shift around, different regimes offer different deductions, you get the idea. By opting into this specific default regime, Mr. Arvind is subject to a very rigid, particular set of income slabs. Our job right now is to take his 12,300,000 rupees, push it through the precise machinery of this FY 2025-26 rulebook, and see exactly what his final take-home pay is actually going to look like.
Let's move to the calculation and see how this builds step by progressive step. This math right here, this is the core engine of our explainer today. See, we aren't just taxing his entire income at one big flat rate. We are slicing it up into blocks. First off, for the initial 4 lakh rupees he earns, the tax amount is a beautiful zero. Nothing. Next, we look at the income from 4 lakh rupees 1 up to 8 lakh rupees. That's a solid block of 4 lakh rupees. Under this default regime, that block gets taxed at 5%. So 5% of 4 lakhs gives us our very first tax bite, 20,000 rupees. But Mr. Arvind kept earning, right? So we move up to the next slab. 8 lakh rupees 1 to 12 lakh rupees. Another 4 lakh rupee block. And as you climb up, the tax rate scales up with you. This chunk gets hit with a 10% rate. 10% of 4 lakhs is 40,000 rupees. Finally, we arrive at the amount that spilled over that crucial 12 lakh line, from 12 lakh rupees 1 to his total of 12,30,000 rupees. That's a pretty small chunk, just 30,000 rupees. But because it sits up in a higher bracket, it gets taxed at 15%, which comes out to 4,500 rupees. It's a progressive climb. The more you make, the heavier the tax gets on those topmost layers of income.
So if we take all those amounts we just calculated, the zero, the $20,000, the $40,000, and the $4,500, and we add them all together, ouch, we hit an initial total tax liability of $64,500. I really want you to pause and feel the massive weight of this initial number for a second. Think about it. Mr. Arvind's total income only exceeded the 12 lakh threshold by $30,000. He made 30,000 extra rupees, but his initial tax bill is staring him down at $64,500. From his perspective, it feels like an absolute penalty, right? It literally feels like the system is punishing him for working hard and crossing that 12 lakh mark, because the tax bill is actually higher than the extra income he even generated. This right here is what we call a tax cliff. But remember what I promised earlier, the tax code has its own built-in plot twists. And here is that plot twist, marginal relief under Section 87A. Let's slow down the pace right here, because this is exactly where the magic happens. The system actually recognizes that, hey, it's totally unfair for your tax to increase by more than your actual increase in income. To fix this, we follow a very specific two-step formula to calculate a relief amount. Step 1, let's call it A, is to determine the initial tax liability on the total $12,30,000. Well, we literally just did that. It's $64,500. Step 2, which we'll call B, is to calculate exactly how much his total income exceeds that critical 12 lakh threshold. So $12,30,000 minus $12,00,000 leaves us with exactly $30,000. Okay, so here's the crucial point. We have our two vital numbers. Liability, A, is $64,500, and excess income, B, is $30,000. And this brilliantly illustrates how the math actually protects the taxpayer. The code dictates that we find the relief by simply subtracting the excess income from the initial liability. It's just A minus B. So on one side, we have the hefty $64,500 initial tax. On the other side, we have the $30,000 of extra income. When we subtract $30,000 from $64,500, we get $34,500. Guys, this is Mr. Arvin's Section 87A marginal relief. The system is literally forgiving a massive portion of his tax liability to ensure he isn't losing money just because he got a tiny bump in pay. It's honestly a brilliant mathematical safety net.
So let's update Mr. Arvind's tab. We take that initial super scary liability of 64,500 rupees and we subtract our new relief amount of 34,500 rupees. This brings his tax payable down to a much more reasonable, lowered subtotal of $30,000. But hold on, we aren't entirely finished just yet. If you know taxes, you know there's always a tiny bit more tacked on at the very end. On top of that $30,000 base tax, the government adds a 4% health and education cess. Now keep in mind, this isn't 4% of his income, it's 4% of his calculated tax. So 4% of $30,000 equals exactly 1,200 rupees. We just take that nominal fee and add it right onto the subtotal. Which brings us to the grand finale. 30,000 rupees in base tax plus the 1,200 rupees for the cess gives us a final tally of $31,200. Just think about the journey we just took. We started out staring down the barrel of a 64,000 rupee tax bill that felt completely disproportionate. But by methodically applying the rules, specifically that beautiful marginal relief calculation, the tension is completely resolved. Mr. Arvin's final, actual, out-of-pocket tax payable is just $31,200. The system works, well, as long as you know how to read the blueprint. Now, what's really interesting about this slide is this is the exact raw data we started with. Look at it now. I mean, a few minutes ago, this might have looked like an intimidating wall of accounting jargon, but now you can read it flawlessly. You can see the progressive tax slabs scaling up from 0 to 5, 10, and 15%. You understand exactly where that daunting $64,500 at step 1 came from. You can trace the logic of step 2, effortlessly identifying the $30,000 of excess income. You see the Section 87A marginal relief subtraction happening right there in the middle, saving Mr. Arvind a whopping $34,500. And finally, you see the addition of the 4% cess to reach the perfectly logical conclusion of $31,200. What used to be a terrifying table is now just a clear, highly structured story of Mr. Arvind's finances. Which leaves us with one final thought to close out this explainer. We've just decoded Mr. Arvind's financial reality under the default regime. We navigated the slabs, and we used marginal relief to find the actual truth behind the numbers. But what about you? Do you know how your own income scales these exact same tax slabs? Have you ever calculated if you're sitting right on the edge of a tax cliff, or if there's a hidden relief mechanism waiting to soften your liability? The next time you look at your total income, don't just see one big static number. Remember this explainer, break it down into blocks, and apply this logic to your own calculations. The numbers are always trying to tell you a story. You just have to know how to read them.